All right, so tax season rolls around. You're sifting through your mail and you get this official-looking document from work. It's not your W-2. It's something called Form 3921. And, your brain immediately starts spinning. What on earth is this? Do I owe more money? What am I even supposed to do with this thing?
Yeah, if you're feeling a little bit lost right now, you are definitely not alone. This form is honestly famous for being confusing. But hey, don't worry, in this explainer, we are going to break it all down. By the end of this, you'll know exactly what this form is for and precisely what you need to do next. Okay, let's just dive right in. First things first, what is this form? Before we can figure out what to do with it, we kind of need to understand the problem it's trying to solve in the first place. So let's cut right to the chase. Forget all the complicated tax jargon for just a second. The absolute simplest way to think about Form 3921 is that it's just a receipt. That's it. It's nothing more than a record of a transaction you made. So here's the deal. Form 3921 is purely an informational document. Your employer sends one copy to you and another to the IRS, just to let them know that you bought company stock using your incentive stock options, or ISOs. The most crucial part, it is not a bill. You don't owe any money just because you got this in the mail.
And this leads us to the single most important action you need to take, which, funnily enough, is to not take any action at all. You do not file this form with your taxes. Seriously, just keep it for your records. Its whole purpose is just to give you a few key numbers that you'll need later when you actually do your taxes.
So now that we know what it is, a receipt we don't file, let's figure out how to read it. Think of yourself as a detective. The form is a puzzle, and a few of these little boxes are the clues that tell us exactly what the IRS is looking for.
Don't worry, we can ignore most of it. We only care about 4 key boxes. Box 1 is the grant date. That's just when you were first given the options. Box 3, that's your exercise price, the special low price you got to pay for each share. Box 4 is the fair market value, what the stock was actually worth on the open market the day you bought it. And Box 5 is super simple. It's just how many shares you bought. Easy enough, right?
So why? Why does the IRS care about these specific numbers? This right here is the big reveal. This is the aha moment. All of these clues on this form point to one very specific, and let's be honest, often misunderstood part of the tax code, the alternative minimum tax, or AMT. Now, to understand this AMT connection, we need to get familiar with a term called the bargain element. All this is, really, is the on-paper profit you made the instant you bought the stock. It's the gap between what you paid and what it was worth. This is the number the IRS is really interested in.
And you know what? The math to figure this out is incredibly simple. You just pull the numbers right off your form. You take the fair market value from Box 4, in this example that's $10. Then you subtract your special exercise price from Box 3. Here, it's just $1. That gives you a bargain element of $9 per share. Then you just multiply that by how many shares you bought from Box 5.
So in our little example, that's $9 per share times 1,000 shares, which gives us $9,000. That right there is the total bargain element. That's the key figure that this whole form is designed to help you find.
Now, you didn't actually get a check for $9,000, did you? It's not cash in your pocket. You just have the stock, and that's exactly why this is often called phantom income. It's income that exists only on paper, but it exists for a very specific tax purpose, calculating that alternative minimum tax.
And there it is. That's the final piece of the puzzle. You or your accountant will take this phantom income number, that bargain element, and you'll report it on a totally different form, Form 6251. That's the form for the AMT. This connection right here is the entire reason Form 3921 was created and sent to you.
Okay, before we finish up, I really want to highlight the single biggest point of confusion around all of this, because honestly, getting this wrong can be a really expensive mistake. It's absolutely critical that you understand the difference between exercising your options and selling your shares. Listen, these are 2 completely separate events in the eyes of the IRS. The exercise, buying the shares, that's what we've been talking about. That triggers Form 3921 and is all about the AMT. The sale happens later, maybe a year later, maybe 10 years later. That's a totally different transaction that gets reported on a Schedule D and deals with capital gains tax. Whatever you do, don't mix them up. Whew! Okay, that was a lot, I know. So let's just boil it all down into a super simple final action plan. Here's everything you need to remember. Here we go. Number 1,
Keep Form 3921 for your records, but please do not file it. 2. Use the numbers from boxes 3, 4, and 5 to calculate your bargain element. 3. Take that bargain element and report it when you're preparing Form 625 for the AMT. And 4, and I cannot stress this enough, always remember that exercising and selling are two completely separate tax events.
And look, of course, I have to give the important disclaimer, this is all for educational purposes, just to help you wrap your head around the concepts. I'm not a tax professional, and your situation is totally unique to you, so please always consult with a qualified tax advisor or a CPA before you make any big decisions.
So there you have it. Form 3921 isn't some scary mystery anymore, is it? It's really just a receipt with a few clues you need for the AMT calculation. You've officially decoded the exercise. But that does leave one big question, doesn't it? Are you prepared for what comes next? The eventual sale?